As I mentioned last week, these weekly market updates are going to be transitioning to being exclusive to the Obsidian Council in the near future. This is a preview of what those updates are going to look like once they move over to being exclusive. That's going to happen at some point in the next few episodes. It could be the next episode. It could be the episode after. I'm not quite sure. I haven't given an exact deadline, but at some point that's going to transition over to being exclusive to the Obsidian Council. At the same time, I am ramping up the amount of content I'm putting out on YouTube on my main channel. So that's a good way to kind of supplement transitioning this content over. All right, in this week's update, we're going to be diving into the state of liquidity as it is currently, looking at dollar strength and a bunch of other indicators just to get a overall health assessment of where liquidity is currently. We're going to be looking at the state of the cycle. So looking at various different cycles and kind of seeing where we're sitting right now, how that's lining up, as well as I'm going to be diving into the bear case for the markets going forward. I talk a lot about what's bullish. I talk a lot about, the bullish outcome that I see coming, but I think it's worth exploring what is the bear case for the markets going forward and how could this go terribly wrong and what might I be missing? What might we be missing and what would that outcome look like? We're going to really dive in depth into that bear case today. So if you're not wanting to feel bearish, this might be a good episode to skip. But if you're wanting an honest assessment, I'm not going to hold back any punches. I'm going to really go in depth. If you're wanting an honest assessment of the other side, like what are the risks? What is really the bear case going forward? That is what we're going to be diving into today. Lastly, it is Liberation Day, as Trump calls it. So we're going to be diving into all the updates around that. I'm actually going to be recording a part of this pod in the morning, and then I'm going to record like a secondary piece of this pod later in the afternoon after the Rose Garden announcement Trump gives on Liberation Day, just to dive into all the details around the tariffs, what it means, and kind of updating the picture going forward. Let's start off with the state of liquidity, looking first at dollar strength. Dollar strength is one of the key indicators that I'm keeping an eye on right now, especially because in 2017, as we talked about before, we really saw, so in 2013, what drove the market up is we had abundant credit, we had dollar strength staying low. It wasn't falling, but it was low. And then we had abundant liquidity. In 2021, we had the same thing. We had abundant credit. We had dollar strength falling, and then we had abundant liquidity. 2017 was kind of a unique bull run in that there wasn't necessarily abundant liquidity, but we did have dollar strength plummeting, and we had abundant credit. And remember, 2017 was Trump's first year in office, and you can see kind of the same exact sort of outcome playing out where, early on in the election, we saw dollar strength rise really high. And then we saw dollar strength really just fall off a cliff going into the rest of the year until it kind of hit a low in 2018. And it went from 103 to a low of around 88, which is a pretty extreme move in dollar strength. And coming back to today, we saw heading into the election, dollar strength rising, where it hit a high of 109. And then we saw it start to fall off a cliff, right? Where it went from 109 to a low of around 103. And looking at today, we see the same thing. Dollar strength rose going into the election, and then it started to fall off a cliff in a similar fashion. And if you go back to the 2017 one, it's really April where the decline really accelerates. And now that we've hit April, we can see earlier around March, we did see this kind of spike in dollar strength that was worrying people. People were thinking, man, what'll happen? Is this going to go a lot higher? Because that'd be really bad for liquidity. That'd be really bad for the markets. Again, dollar strength was one of the key factors in 2017 that contributed to us having that insane bull market. So dollar strength falling off a cliff was one of those key factors. We want dollar strength to go down. Dollar strength going down means abundant liquidity. It plays a huge role in the global liquidity equation, okay? And so the more it declines, the more we're going to see global liquidity rise up. And that is especially true right now, especially when you look at countries like Europe and China. They want to stimulate. They want to do things with their currency, but they need dollar strength to fall. And we can see that even though we had this kind of little rise up that was freaking people out, we're now starting to see it decline again. And so really the key thing to watch is going into April, do we see it decline further? And do we see a 2017 style repeat where dollar strength falls off a cliff and comes potentially a lot lower? The ideal outcome would be, somewhere down here in the 90s, like what we saw in 2017. Seeing dollar strength fall all the way down here would just be a huge boost when it comes to liquidity, the markets, and all kinds of things. And again, as I've talked about before, Trump wants it, China wants it, Europe wants it. Everyone wants dollar strength to fall. So we're going to keep a really close eye on this, but it is headed the right direction. Looking at global M2, which is really, really hard to measure. Okay, so there's a lot of charts that go out online where it's like, this is global M2, this is global M2. There is no one standard global M2 chart like something like dollar strength. It's more people piecing together different like data points to try to come up with a global M2 number. Right now I'm using this one. There's a lot of them out there. So, it's again, really hard to track and no consistent like, hey, this is global M2 number out there. Weirdly, you think there would be, but for whatever reason, there isn't. But this is a good overall starting point to give you kind of an idea of what global liquidity is doing. And you can see, looking at this chart around 2020, COVID hits, the amount of global liquidity that just like pumped into the system was just absurd as far as like historical norms, right? You can see that from right here to right here. And then we've been kind of like trending up in general, kind of like a sideways up. That looks kind of more or less similar to what we were seeing back here before we had this huge burst of liquidity, global liquidity because of COVID. Now, if you zoom in to this time frame, because remember that we were looking at like a decade's worth of global liquidity data, you can see that in September of 2024, global liquidity really fell off a cliff. So it really, really declined. This is about when we started the Bitcoin rally, the crypto rally, where it just got out of control. But then it really just kind of hit a bottom here in January. And, around December, January, we started to see that really get priced into the market where crypto prices started falling off a cliff. It wasn't just because global liquidity. There was a lot of factors, I think, at play. The Fed not cutting as much, a bunch of different things. But we can see that this does correspond pretty well with like this decline in liquidity. We saw also a decline in the crypto markets, especially alts. Especially alts were like heavily affected by this. So you can see the decline started in September, and it really didn't even start to get priced in until December, January. So it's like 3 to 4 months later, we saw this really start to get priced into the market. If you take into account this 3 to 4 month lag time, remember in November, we just went crazy. Prices went nuts. Bitcoin just skyrocketed. But then it started to kind of falter in December. So if you take into account this 3 to 4 month lag time, so liquidity is falling, it doesn't really affect crypto prices for like 3 to 4 months. Then we just really start to fall off a cliff. Well, then that should be true on the opposite end, right? So as liquidity bottoms and starts rising, 3 to 4 months later, we should really see that kind of taken into effect in the market. And that would put us at around April, May. So April, May, somewhere in there, if this is true, if this is accurate, we should see prices start rising based on this increase in liquidity that we're seeing right here. Now let's take a look at credit and what's happening with that, because credit is actually a key ingredient. A lot of people talk about liquidity. Not enough people talk about credit, because credit is a key ingredient into what allows crypto prices to really expand and go up. And you can see on this chart, preceding every bull market, we see this huge decline in the spread. So you can see right before 2013, we see this decline. You can see right before 2017, we see this decline. You can see right before the 2021 bull market, we see this massive decline. And you could also see that, in times of crisis, this spikes up really high. So in 2008 financial crisis, we saw this spike up really high. During the dot-com collapse, you saw this spike up. During COVID, we saw this spike up. And you can see somewhat in a similar fashion, we have seen a decline since 2022 of this spread kind of heading lower and lower, which is bullish as far as credit goes. Although that's not really the full picture as far as credit goes. And there's a lot of other factors that are influencing credit and lending and all of that right now that are a lot more complicated than you can just put on a single chart. Lastly, as far as credit goes, let's also look at the 10-year, because this plays a huge role, especially in the US with the housing market and all that kind of stuff. And you can see during the 2013 bull market, the 10-year was sitting around 2. You can see that during the 2017 bull market, the 10-year was also sitting around 2. You can see during the COVID bull market, the 10-year was sitting a little bit under 2, around 1.7, kind of in that range. But ever since the Fed aggressively hiked rates faster than ever before in history, going into 2022, ever since the market started pricing that in, the 10-year has just climbed up to an absurdly high, at its peak, almost 5%. This is one of the reasons right now it's really hard to go buy a house, because, the rates are so high. People keep asking, like, the Fed's cutting rates, why are these rates not going down? And that's because a lot of it has to do with the 10-year. And not as much with the Fed cutting rates as it does the 10-year. The Fed cutting rates has an effect on the 10-year as far as that goes. But really right now, the 10-year is just stealing the show. And this is what Scott Bessent and Trump are really focusing on, is getting this thing down, because that should cause an economic boom. A lot of people buying houses, a lot more abundant and cheap credit. We really need to see this thing get back, at least down to this 2 range. Would be ideal. And looking really closely at it, you can see it's heading the right direction, right? The 10-year is at least heading somewhat down. And we do know that the Trump kind of way to tackle this is through the SLR, supplementary leverage ratio, and different kind of deregulation attempts like that. This should cause a lot more buying of the 10-year, which should push these rates lower. There doesn't seem to be a ton of demand from other countries like there used to be historically. And so they're going to have to get a little tricky with it if they really want to get this lower. Another thing is really leaning into stablecoins. Stablecoins are actually a huge buyer of government debt. And so maybe between those two things, they can push it lower. That is really what we want to see. And that's really what we need to see, because credit is a core ingredient in what creates an insane crypto bull run. And as far as credit cycles, I've talked about it before. It looks like we're heading into the expansionary phase of the credit cycle. It's really hard to, some people argue that we're not, that we've already been in that for the past couple of years. But again, the Fed hiked rates faster than ever before in history. We just saw a massive tightening of credit over the last couple of years, which leads me to believe that we haven't been in the expansionary period of the credit cycle the last couple of years. That just doesn't make any sense to me. We've been in a tightening phase, and we're going into an expansionary phase. And that lines up, again, with the core kind of things the core signals we're seeing from Scott Bessent, Trump, et cetera, where they're saying they're going to deregulate the private financial markets, loosen up credit, which should mean expansionary credit, which is really, really good for your bags. Okay, expansionary credit, super bullish for your bags. There are really, again, 3 core ingredients when it comes to Bitcoin bull runs, crypto bull runs, and that is abundant credit, liquidity, dollar strength falling. You don't need all of them. But you do need some of them. And so far, present in every crypto bull run has been abundant credit. That has been present in every single crypto bull run. Looking at the business cycle, looking at, where's the economy? Think of this like the health of the economy. How strong is the economy? Is it looking good? Is that thing pumped up? Is that thing pumping some iron? Or is that thing kind of faltering? The ISM Purchasing Managers Index is a really good indicator of kind of where that is. And you can see like 2008, after 2008, this thing fell off a cliff. This thing was looking brutal. And you can see going into the 2013 bull run, this thing was looking really good. Like this thing's heading up, it's looking really high. You can see going into the 2017 bull run, look where it's going. It's going up, it's going high. You see going into the 2021 bull run, right? Where's this thing going? This thing's going up, it's going high. So we want to see this going up, because every bull run we've had that's been insane, we've seen this spike up. Okay, so we need the business cycle going with us too. And even going back to the .com bubble, you can see these huge spikes up that kind of correspond with the .com bubble as well, and then this huge decline that corresponds with the bubble popping. So this is a really important one when it comes to seeing it. Are we going to get a bull market? Or are we not going to get a bull market? And right now, you can see we kind of started to head the right direction. It was looking a little bullish there for a second, but now we're kind of retracing back. So this one is TBD. We don't really know. We got to wait and see kind of where this starts heading. As you can see, when it heads up, it does it pretty quick. It's not like it's a slow climb or anything. It's just like this thing just heads up, right? This thing starts skyrocketing. It goes bananas. It goes up. We can see in 2013, that was the kind of smallest of the 2 or of the 3 bull runs. It only got up to about 56. So we don't need to go too high, right? If it gets anywhere up here, that's a strong economy, strong business cycle, and things are looking good. Corresponding with that, obviously, in the 4-year cycle and in the presidential cycle, we're sitting in the most bullish possible year. Okay, 2025 is the bull run year. If you look at the 4-year cycle, you have 2013. The next bull run year is 4 years later, 2017. Next bull run year is 4 years later, 2021. That will put us this year, 2025, should be the insane bull run year. But it's not quite playing out that way, the way we've expected so far. But that is in cycle position wise, that's where we're currently sitting. And so it is something to keep in mind. Let's dive into the bear case. A lot of you guys hear me talking all this bullish stuff. You always hear me talking about like why I'm so bullish because of this, why I'm so bullish because of that. But I don't often talk about the other side, the bear case. And I think that is really important to dive into. Like how could we be wrong? What could we be missing? How could all of these plans fall apart and lead us to a terrible, terrible outcome? And, some of you guys might mentally not be able to handle this. So if you can't mentally handle this, this is your chance to step away. This is your chance to turn off this, video, walk away, keep yourself in bullish land because I'm about to head to the bear territory. I'm about to show you the other side. This is going to be a scary video for some of you guys because I'm going to show you the weaknesses, the flaws, and where this plan could go terribly, terribly wrong and end in utter defeat for all of us. And basically, there's kind of like two scenarios. I spent a long time thinking about this, really breaking it down, trying to see. I guess there's three. There's three main scenarios that we could really see these things, this whole plan fall apart. The first one is just an extreme one. Okay, I've talked about it before. World War III, something insane like that, right? Like crazy outcome. That's like, we don't even care about our bags at that point. We're like trying not to die. That outcome, obviously, markets tank, everything falls apart. Not a good outcome, right? So we'll side table that one because everyone knows about that one. That's an ever-present risk for any market state. We're side tabling that one. The other two are more focused and I think more particular and to what we're going through right now. The first one is if we have a scenario where something breaks in the market, that could lead to some insane short-term pain. What do I mean by that? What I mean by that is not something like COVID, not something like World War III, but something like what we saw in 2023, something like what we saw in 2008. If we have some sort of thing in the market break, remember, we just went through the fastest rate hiking cycle in history. We've hiked rates faster than ever. And there's a certain lag effect after that. So we hiked rates and we've been kind of starving the markets of like this abundant, cheap credit, abundant liquidity they've had in the past. Maybe there's cracks in the system. Maybe there's something waiting, toxic in the financial system, the financial plumbing of the global economy. It's just waiting to collapse, waiting to break. It's rotting from the inside out. And when that happens, it'll be a 2008 style collapse. It'll be a 2023 style banking crisis. That is certainly a possibility. Think about it like your windshield. I remember when I was a kid, my windshield, it had been like frozen for some reason. And then it got like really hot the next day. And then somebody sprayed like really cold water on it again and the whole thing cracked. Something like that. Like when you have these dramatic shifts in the financial temperature, things can break, things can crack, and things can fall apart. And so there could be cracks in the system. And this is something I've talked about, over the past couple of years. There could be cracks in the system. Think about crypto, right? When we saw the liquidity retract from crypto, the tide go out, we saw a lot of things break. We saw the Three Arrows Capital, Terra Luna collapse, FTX collapse. It exposed the weaknesses. Now, think of that as like a foreshadowing of potential collapse in the wider market. We think we've already seen that. We think the 2023 banking collapse with Silicon Valley Bank was kind of like, that was the big emergency. Fed dealt with it really well, and that was that. But what if there's something deeper, something more sinister, like hiding in the financial plumbing that breaks? That's a possibility. And if that were to happen, that would be some extreme short-term pain. That would mean we're not even close to the bottom, and we could see one of those like 2020 style COVID dips where it just like falls off a cliff. Okay, so where the market just literally plummets off a cliff. Now, I will highlight that if you look at that 2020 style COVID dip, what happened after is we entered an insane bull run, because when you see that happen in the system, the government is going to respond. What's going to happen is the Fed's going to print or lower interest rate. They're going to do QE. Government's going to do intervention. They will react swift and fast, and you will get abundant liquidity, cheap credit, QE, and then it's off to the races, and we make a ton of money. So that really is a short-term pain scenario. That is not a end of the world scenario, but it would mean that we would go through some insane pain in between now and what would be an insane crypto bull run that we would see happen later. So that is one outcome that is definitely a potential. The 2023 style banking crisis, we saw something similar where it was bad, it was insane, but ultimately it was actually really good for crypto. And, crypto did really well in response to that, right? So, and 2023 wasn't as insane as the COVID dip, certainly wasn't as insane as 2008. But you get the idea. That would be a scenario where we would have short-term upfront pain, but long-term it'd be fine. It'd be fine because unless the government didn't do anything, unless they just sat on their hands, which would be, that would not happen. I would bet every dime I have times a billion that they wouldn't do that. There's just no outcome where they would do that. So we have a Fed for a reason. The government would respond as it always responds, and we would see a ton of liquidity, ton of credit, all that kind of stuff enter the market. So it'd be short-term pain for long-term gains. And ultimately, we'd be a lot higher than we are today, in my opinion, and we'd all make a ridiculous amount of money. So, bearish outcome, yes. Okay, I'm supposed to be giving you that bear case, and I promise I'm not going to rob you of that. I have an even scarier scenario next. But that one really is like a reality for sure. I don't want to catch anyone off guard if that something like that happens. The market, we have this financial plumbing issue. But ultimately, it's almost, it sounds stupid. It's almost bullish because that pain brings just a ton of irresponsible government things that pump our bags. Okay, so pain, then a lot of stuff that pumps our bags. But then we're back to the same kind of thing where, obviously next year or the hangover from that would be absolutely horrible and we would see a huge sell-off on the other side. But we know about these things. We're smart. We've been paying attention to the markets for the last couple of years. We're not going to be the ones holding our bags down at the bottom. That's going to be everyone else. So, I think we'd be fine with that. Now, there is another scenario that is hyper bearish. That is a looming threat. And I think probably best represents the most solid bear case against everything that I've been talking about for the last couple months. And that would be the idea that since the 2008 financial crisis, we've been in this era of cheap credit, easy borrowing, and low rates. And that's led, obviously, a lot of people to borrow a lot of money. When rates are basically zero, you are going to borrow as much as you can. And we were at basically zero for like a decade. Okay, so a long time. People got used to this. This was normal. This was like life. This was how things were. And you can see that on this chart, right? So in 2007, going into 2008, we had the financial crisis. Fed cut rates really aggressively to try to starve off that crisis. And then we sat at basically 0% from late 2008 all the way to 2015. And even then, like when they started to raise rates, they only went up to about 2. They went up to about 2%. And then, what happened after that is they dropped it off a cliff again, and then we were back at zero. Every bull run we've ever had has been here. There's 2013, 2017, right? We did have it in 2017, but again, we're still really low. Like, especially if you're looking historically, right? If you look at the historical picture, we're really low over here in 2017. It's not that bad comparatively to everything else. And then 2021. Okay, so everywhere over here, we're sitting in really low rate land. I mean, just look at this chart. Look at this chart and look at where we're at the bottom right here for every single bull run. But look at where we are right now. We're way up here. We're not even close to where every other bull run has been at this like bottom dollar rates. So there's that. That's like bearish right there because it's like, hey, we've never had a bull run where we've been this high. We've had it like right here. We had a bull run right here. That's still a lot lower than where we are right here. So that right there is bearish. Also, you could also make the argument that think about how many people took out debt right here that are going to have to refinance up here. They took out a ton of debt. Now they need to refinance up here or maybe take out more debt and they can't afford to do it. So what happens when a business, is running on cheap, abundant debt and then that gets shut off and that's how they're used to operating? You're going to see a lot of businesses collapse. You're going to see, maybe markets collapse. You're going to see a lot of bad stuff happen because, they're used to this. They got addicted to the cheap rate cocaine. And now they have to deal with reality up here. Okay. They don't even know how to operate in this zone. That is maybe the most clear bear case that there is that, if the Fed is going to keep rates up here, and this is what people are used to, that could be a recipe for disaster. So that's the bear case. And I feel like that's a really honest, just upfront, hit it hard bear case for and probably the best bear case for why we won't see a 2025 bull run, why things could be horrible, and why we could see disaster. And I think there's some real threat there. Now, let me give you kind of the response that I believe, because I actually don't believe the future's bearish. I believe the future's bullish. Even knowing these things, I still believe the future's bullish. And the reason is because the Fed isn't static. The Fed can react to these things, and the Fed can preemptively react. And that's really what it comes down to. Do you think so on one hand, you have the Fed fighting inflation over here. Okay, so they don't want inflation to come back. On the other hand, they're looking at the economy and all this stuff happening, and they need to preemptively stop that. And so they kind of are stuck between a rock and a hard place. If they cut rates, maybe inflation flares back up. If they don't cut rates, maybe the economy breaks. And, what do they do? When it comes down to it, if the economy starts breaking, they've already said they're going to cut rates, period. Like that's economy starts breaking, they're cutting rates. And they've already said that their plan to crush inflation goes into 2027. Okay, so their plan to crush inflation goes all the way into 2027. So they've like, this is a 2-year plan. This is our 5-year plan to crush inflation. They have really soothed market expectations. Like we're not going to get this under control anytime soon, just so you know. And but we will eventually. In my opinion, they're doing that because they see this same data. They know, all these things. And they know that they might have to cut and cut pretty aggressively here in the near term. I've actually heard the argument that the only way that they're going to offset this debt refinancing is that they're going to have to do some form of QE, but not like obviously direct QE, because they've already said, hey, we're not going to do any QE till rates are 0. So I guess they could lower rates all the way to 0 and then do QE, which would be insane. But maybe if something breaks bad enough, that's exactly what they would do. But the other alternative is like some sort of stealth QE. They'll name it something else, but it's effectively QE, and they're pumping that into the markets, and that kind of starves. It gives enough liquidity to the markets so that this debt refinancing isn't a huge issue. I think between the deregulation of the private financial sector and kind of walking back some of these 2008 overreactions to the financial crisis, I think between all these things, my belief, and maybe I'm too optimistic, is that the government's going to strike the right balance, and that everything's going to turn out well. And I think the worst case scenario is that we have something break, like I mentioned earlier. Things short term get brutal, but then that's when the Fed cuts straight to 0. QE starts getting pumped into the system, and then the market goes absolutely bananas. So it's like one outcome, kind of this nice soft landing they've been talking about. Everything kind of goes well and the markets pump. Other outcome, we front load some pain and then markets pump. Those are my two scenarios. I really don't see, when I give that bear case, it's like assuming the Fed just doesn't do anything. The Fed decides to just crash the economy. But the Fed was created after the Great Depression, right? After the Great Depression, this is exactly what happened in the Great Depression. You had abundant, cheap credit and borrowing. People were piling it into businesses and investments and all that kind of stuff. And then you had a retraction of that where it was no longer available. And all that debt stacked up. And then the whole house of cards unraveled, and there was no one to come in to save them. And that's why they ended up ultimately creating the Fed, to manage situations like that. So that is literally the Fed's job. The Fed's job is like, hey, we come into a situation like this, you cut rates, you provide QE. That's your job. You fight inflation and do this. You got to put out fires. That's their job. And so that's what they're going to do when the time comes. And unlike COVID, unlike some of these other previous points in history, the Fed is sitting really fat and healthy, sitting at 4%, whatever 4% rates. They have a lot of room to cut. They have a lot of room to navigate any sort of problem we could possibly face. And I just don't believe that it's really that big of a deal, or that that's going to be some horrible outcome where it's going to be like a Great Depression. Because that's really what you have to be. That's what you're betting on, right? If you think that things are going to just continually get worse and we're never pumping out of this, you're anticipating this like multi-year depressionary period where the Fed does nothing. All this stuff falls apart and it's just horrible. But like, when does that happen in modern history? 2008 financial crisis, things were bleak, but then the Fed started pumping that QE into the economy. Rates were down low, and then everything spiked up, and we've had this decade of just like prosperity as far as like the markets go. So it is my belief that one day the Fed's not going to be able to do this. That the runway will run out. Like we won't like. I think these things are going to continue to accelerate, and eventually, like the debt comes due, payment comes due, and we're going to have a reckoning. We're just not there yet. we're not close there yet. We have a lot of runway left. The government's going to continue to do stupid stuff, run this thing in the ground, kick the can down the road. One day there will be no road left to kick the can down, but we're not there today. So where does this leave us? And I don't want people to be confused here, so I'm going to spell this out really clearly, okay? On the short term, the reason we're selling off is not all this stuff I've been talking about, okay? The reason on the short term we are selling off is because of that liquidity retraction that we traced out earlier, coupled with the uncertainty around Trump policies, tariffs, and inflation. That is why we're selling off right now. We already know liquidity peaks back up. We saw that in the chart, and there's a lag period behind that. When that clears, this should all clear, okay? That's short term. What we're talking about is more the medium term picture, Okay, what could arise in the medium term? That's the financial plumbing outcome that could happen. That's this debt refinancing that could happen. That's medium term problems and the bearish outcome that could happen. That could also not happen. We could totally navigate that and be fine. Okay, that's just it could happen, could not happen. Whatever. The long term was what I was talking about. Is say medium term we do have something break. Say medium term we do have these debt refinancing issues. The long term is bullish. The long term is bullish because the Fed cuts rates, QE comes in, markets soar. Okay, so long term is bullish. Short term, waiting for some clarity from this uncertainty and liquidity lag to catch up. Medium term, maybe there's some pain in there, and we want to know that, but we can't know that. We don't know how the medium term is going to play out. But even if there is, we're like in a bullish sandwich. Okay, we're in a bullish sandwich. That is a great way to say it. There might be some not fun stuff in the middle, or there might not, okay? But on the other side of this sandwich is the bullish, beautiful bread of life, okay? Sitting over here, the bread of the markets, the bread of good bags of joy. This analogy is falling apart, but you know what I'm saying, okay? We're in a bullish sandwich, and on the other side is a great outcome. On the other side, I cannot think of a way that we don't reach Valhalla on the other side of this, hard to navigate space. Okay, so we see it. It's there. It's across the ravine. We know where we're going. We just don't know if we're going to get attacked crossing the bridge. But even if we get attacked crossing the bridge, we know the Avengers are waiting in the rafters to just lay down the law if that happens. Okay, so it's we might get attacked across this bridge. But if we do, boom, Avengers deploy and that gets wiped out. And the whole team's here, okay? The whole team plus some extra people. And they're feeling really, really good right now, okay? It's not like we only have one person left. Everyone else is, gone doing something. The whole team's here, okay? So we have plenty of ammo to deal with any situation we might encounter crossing this bridge. And the other side's looking beautiful. So that's where I want to leave it. All right, it's a couple hours later, and Trump just finished his Liberation Day speech, going into all the details of the new reciprocal tariffs and how they're going to play out. Basically, he did a big long speech about why all these other countries are ripping off the U.S., that it's not fair for the U.S. to just kind of sit there and let that happen. And so the idea is reciprocal tariffs that respond to what they're doing to us. So it's like a matching what they're doing for us. So if they're charging us 30% tariffs, we're charging them 30% tariffs. That's the original idea. He actually came in at half. So it's if they're charging us 30% tariffs, we're going to charge them a 15% tariff. If they're charging us a 90% tariff, we're going to charge them a 45% tariff, and so on and so forth. So he had a whole list of countries. And the idea is they're already charging us, they're already taxing us via their tariffs, so we're going to tax them back via our tariffs. Now, I think the surprising element of this was that he wasn't just matching tariffs. And I think this is the part that threw a lot of people off guard. He was doing kind of like an aggregate of tariffs, currency manipulation, and trade barriers, basically trying to hit all possible fronts a country might try to get one over on the US when it comes to trade. He wants it to be equal, he wants it to be fair. That seems to be the idea. And so if they're, maybe they're only charging us a 10% tariff, but maybe they have a bunch of trade barriers. There's a bunch of extra rules for US importers and a bunch of extra taxes and things that they got to do that makes it ridiculously expensive to import goods into that country. There's a lot of ways that countries will maybe not have an outright tariff, but they'll have these things kind of around it to make that process more expensive, to protect their manufacturing in their country, and make it less competitive. Regardless, because of the inclusion in trade barriers and the inclusion of currency manipulation, this added a lot more as far as the total size of the tariffs than I think what a lot of people were expecting. The things I really liked about these tariffs is a couple things. First off, the tariffs are live. They're done. Liberation Days happened. Tariffs are here. We have clarity. It was uncertain. Now we have a certainty. This is exactly what he's doing. This is how it's going to work. The markets have that, everyone has it, and now people can take that information, come up with their forward projections, and we don't have as much chaos and uncertainty. I think that's going to be insanely bullish for the markets. The second thing I really like about them is they're simple. They're really easy to understand. Hey, you are charging us, you are doing these things to us. We're going to do the exact same things to you. That is, it's not like he's just coming up with, I'm going to add 80% tariffs to this country, 50% tariffs to this country, 20% tariffs to this country. It's reciprocal. And I like that. I think that's easy for people to understand. We have an easy out if these countries want to get rid of the tariffs. And so Trump was really clear, reciprocal. So if they want to get rid of the tariffs, they can cut their tariffs, they can get rid of the trade barriers, and then suddenly, they don't have tariffs on their goods as far as selling them to the US. And for countries that maybe don't respond like that, which I'll get into that into a second, you have companies, if you're in a country that's doing these, that has these big tariffs, you can build in the US, you can come build a factory in the US, move your production to the US, and then you can completely avoid those tariffs if your goods are made in the US. So there's multiple outs as far as that goes. But as far as it's like some of these countries, I would expect like ASAP, right away, you're going to get a lot of these countries coming to the table and saying, hey, we're going to slash our tariffs. We're going to remove these trade barriers. You don't do anything to us. We don't do anything to you. That sounds like a way better deal than these absolutely insane tariffs on all of our goods, because the US is the customer of the world. The US is the consumer of the world. And so a lot of these countries make most of their money selling goods to the US. And so it's way more devastating for them than it is for the US as far as things go. So I would imagine a lot of these countries are going to rush to the negotiating table to fix everything Trump wants them to fix as fast as possible. Now, let's talk about the markets, because we're not here to talk about politics, if this is good or if this is bad. You can come up with your own judgment on that in your own free time. What we're here to talk about is how is that going to impact the price of crypto? How is that going to impact the price of Bitcoin, etc. Now, short term, you're going to have short-term stuff happen. Okay, what we're wanting to know is once people digest this, what comes next? My personal take is that meeting went as well as you could possibly expect. Like, that is everything I want. I heard everything I wanted to hear. He's not delaying the tariffs. We got him right now. There's no games. It's really clear what the tariffs are. It's really clear how they work. The rules of the game are really clear, and people can get rid of the tariffs if they want. And so the ideal outcome would be, all these other countries come in and say, hey, we're going to fix all these things. Nobody has tariffs. Everyone has free trade. And that's that. We probably have some tariffs on certain industries and things that are considered national security issues, maybe certain countries. But as a whole, it would be amazing. We wouldn't have really any issues if that was the outcome. We can't assume that's going to be the outcome, but that would be the ideal way things went. I would guess that based off these tariffs, based off the fact that the US is the consumer of the world, you are going to get, okay, so either you get these countries reducing all their trade barriers and tariffs and all that kind of stuff, which honestly, as far as game theory, makes the most sense for the vast majority of these countries to do. Either you get that, which is a good outcome, or you get the fact that the U.S. is going to be making a ton of income off these things. So this is a tax. That tariff is just like another word for a tax. Okay, this is a tax on imported goods, and so that's another way the U.S. is going to be making a bunch of income. If these tariffs were to stick as they are, you're talking just wads and wads of just an insane amount of income coming into the U.S., which would be really bullish overall. For the U.S., for the 10-year and all kinds of stuff. So I think kind of either way you cut it that way, it's bullish. The thing people worry about is inflation, how much is going to get passed on to the consumer. And that's kind of an unknown. We're not going to really dive into that right now. Again, in 2017, it didn't get passed on to the consumer, but in 2017, but this isn't 2017. And this is way more tariffs and way more intense tariffs. Like it's kind of hard to compare. Like given now that we've seen the tariffs, it's kind of hard to compare it to what happened in 2017 because the scale here is like absurdly bigger than what we saw in 2017. So I don't know how that goes, but I think end all be all. You got to remember that tariffs are going to be a one-time inflation increase on select goods, and there's like a bajillion ways that this could go down. Consumers could bear some of the cost. Manufacturers could bear some of the cost. Consumers could switch spending habits and buy those, maybe one of the countries keeps the tariffs and maybe another country doesn't. So consumers, instead of buying goods from country A, start buying those goods from country B because, they're not tariffed or whatever. Or maybe consumers stop buying those goods if it's like just a silly, there's a lot of things that people in the US buy that they don't necessarily need to buy. Maybe they can spend that money elsewhere. Think of, again, all the kind of cheap things that people get off Amazon that kind of break 2 weeks later anyway. It could change spending habits. There's a lot of ways that the economy could process this, okay? And so it really isn't as cut and dry as what people like to make it out to be. It's like, oh, it's going to be a massive inflation hike and all this kind of stuff. And it's like, no, you don't really know that, because the way that this could go down, it's a really complicated machine, and you don't actually know how this is going to go down. And there's a lot of ways that it could go down that don't have that outcome. Overall, though, the most important piece, I think, is the clarity piece. That's why I emphasize so much the easy to understand plan, really clear rules of the road. I think that's really important because that gives the market clarity. And to be clear, I'm not saying uncertainty is going to clear up tomorrow. I'm not saying everyone's going to wake up tomorrow, uncertainty's gone, everyone's rushing to buy stuff, that kind of whole thing. Think of it like an earthquake. We just had a crazy earthquake, but now the earthquake is done. There's maybe a lot of rubble. People got to sort through things. They got to figure out what's working, what's not working, that kind of whole thing. People still got to figure out things, right? It's not the certainty. The uncertainty doesn't just dissipate overnight, but the earthquake is done. At least that's what it appears like. I guess Trump could come out and do something crazy with the tariffs on top of this, but it appears the earthquake is done. It appears that we have some closure to this, and that the markets will start to trend towards that point of certainty. And I don't know exactly when it'll hit that, but when it hits that point where the markets just kind of know the outcome, they know the direction, that's when things should get a lot more bullish. You also have to remember, though, that any way you cut it, this is going to be bearish short term for the stock market news wise, as far as that goes, because there's a lot of imports that these companies are valued on cash flows and things like that. A lot of these imports are coming from a lot of these countries. That represents either price cuts for them or loss of customers because they're going to have to hike their prices or whatever because of all these tariffs on these countries. So if these countries don't come to the table ASAP and come say, hey, we're going to cut our tariffs and all this kind of stuff, it's going to be a lot cheaper. That could be bad for a lot of these companies in the US that import all of their goods from abroad, right? So and when I say bad, I mean like say we sort through it in 3 months. Okay, that doesn't matter for short term. In the next 30 days, next week, next 24 hours, the market's going to price in like, oh my gosh, this is the apocalypse as far as earnings for a lot of these companies that aren't software companies that actually import things. And if crypto follows the stock market, which it has been following the stock market, that could be some short-term pain as far as that goes. But you also have to remember that's going to be like apocalyptic as far as like what the Fed's seeing in their data. And that should mean that that should ultimately mean this is, again, dovish, Fed cuts, QE, that kind of thing on the other side of this. So it's kind of a mixed bag. And that's why I gave the earthquake analogy of like, we have some like clarity, like things are settling, like the earthquake's done. But now we got to sift through the rubble and kind of figure out what's standing, what's not. And the markets might tomorrow price in like, oh my gosh, we had earthquake, nothing's standing, and it might be horrible. And then, as people kind of do their audits of, what's left, we might find, oh, actually everything's looking good and there wasn't a lot of damage. And then maybe it gets great as we have that clarity. So short term, kind of expect anything can happen. But we've checked one key component off of our bullish box, which is we're trending towards clarity. I'm sure we'll have a clear picture even in the next week. We'll have a lot clearer picture of kind of what's happening. It's kind of hard to tell just a couple hours after all this is going on exactly what's going to happen. As I said last week, this is going to be a volatile week, and I would expect tomorrow is going to be a volatile market day. Maybe the whole rest of the week's pretty volatile. Maybe next week with the CPI prints, pretty volatile. Long term, if this data comes in, all bad with with the economy and everything, the Fed's going to cut. Maybe they're going to do QE, and things are going to be looking really good for the market. So, it depends how much pain you want to go through or willing to go through. Depends if something breaks in between now and then. Hopefully by next week's update, we have a lot more data and a lot more perspective, and we can see things a little bit clearer. Right now, with all this rubble, all this smoke, it's kind of hard to see all this dust. It's kind of hard to see exactly where things are going to land. But give it a couple days, give it a week, and we should have a lot more clarity as far as that goes. As always, none of this was investment advice. None of this was me telling you to do anything with your money. You are a grown adult and can make your own choices with your investments. I'm just here to hopefully provide you some information, some clarity, and some insight into what's going on with the markets.